So why stocks? What is it about these things that makes them so special? Why do so many people invest in them? And why do so many people rant about them as much as they do when they go up or down? It all comes down to how much money you get out of them for how much you put in. History shows that owning stocks is one of the most effective and most profitable ways to grow your wealth over the long term. Almost every member of the Forbes Richest 400 list is there because they own a large block of shares in a company. Over the past 200 years, stocks have returned an annualized return of about 8% a year. This means investing $100 today means owning $196 in 10 years, all without you having to get out of bed in the morning. Meanwhile, over in bond camp and treasury bill camp, the returns have been much more pedestrian, at 5% and 2% respectively. While this might not seem like a big difference, using the above example, bonds would leave you with $162 after 10 years. And I don't know about you, but if all else is equal, I'll take the extra $30. If you'd like further details on the comparison between the performance of stocks, bonds, and other assets, you can look into this book from Jeremy Siegel. It's a great resource because if you'd rather not have to read a lot, there are a handful of great charts depicting the historical returns of stocks. Another benefit of stocks is that they are one of the best forms of wealth protection against one of the most destructive forces in the economy, inflation. Going back to sweet things, a simple way to picture inflation is through a pie cut into 10 slices. At the start, you and 9 friends each have $1, which happily enough is the going rate for a slice. Thus, $1 buys you 1 slice of pie. However, the government in all its wisdom suddenly decides to print more money, so they give you each one other dollar. Now, altogether, you have $20, but there are still only 10 slices of pie. Sadly, $1 won't be the going rate for slices anymore, due to the laws of supply and demand. The price will quickly be $2 for a slice. Even more discouraging is that in the real world, not all of you will get that extra dollar at the same time, and some of you might never get it, while others will get an extra $3. Those others usually are the banks. Given the historical 2% rate of inflation, inflation eats 1 out of every 5 slices of your pie every 10 years. Luckily, because businesses are able to take steps to counter inflation, you can prevent as much damage as possible through buying stocks. And combined with the high returns, these mean that stocks are clearly a superior investment to cash, treasuries, or bonds. Remember, stocks are the best channel for you to grow the money that you have saved, as they offer the highest returns and are the best protection against the erosion of inflation.